So another question, Daniel, just out of curiosity, let's say when you buy oil, right? When uh, let's say when you buy the oil, do they hold it? What do they do? Or if you buy any other, let's say,
So
commodity?
when you say buy oil, it's not like you go to Exxon, you say, hey, can I have X amount of barrels?
Yeah.
What typically that's facilitated through what is called a futures contract or an options contract. You can also do it with something called a CFD contract. And we're going to be talking about those understanding those things is really paramount to understanding trading. So it's a very good question. I'm glad you brought that up. So when you buy oil, you don't actually, like I said, go to Exxon and say,
Hmm.
hey, give me,
Yeah.
with your little portable thing for the car, here you go.
Yeah.
What you do is you buy a contract on a certain amount of barrels. I don't remember off the top of my head, Chen, was that $1 million worth of barrels of oil or 100,000?
Hello, can you guys hear me now?
Yeah, yeah, yeah.
Yes.
Okay. Yes. So to answer Danny's question, one futures contract for a barrel of oil essentially allows you to command 1,000 barrels in the market, right?
1,000 barrels.
And so when
Okay.
you're trading leverage contracts, right? So when you're trading a leverage contract, you're typically be associated with the price in the market. So if the price in the market, hypothetically speaking, is $55 per barrel, when you buy one futures contract, your contract essentially allows you to command the price of 1,000 barrels in the market. So using your one leverage contract, you're making a play on 1,000 barrels of oil, right? So when you buy one contract, the price goes from $55 to $56, right? You
Mhm.
take that price per barrel and you multiply it by 1,000 for every barrel within that contract, and that's essentially what you make in terms of the difference in the market, right? The leverage structure is just basically your ability to trade that one futures contract with using like a couple $100. So the total worth of that contract is 1,000 barrels times the market price. But you only have to put up like several $100 in order to trade that product when you use contracts such as like futures or options, or as Danny was mentioning earlier, CFDs is another way to participate in markets that allows you to access leverage. Okay, so
Yeah. So
that
so the
answers your
key
question.
the key here is leverage, right? And a lot of people come to us and they're like, oh, I like to day trade stocks and so forth, and we're like, well, why do you really want to do that? What's your reason? And most of the time it's just because people heard of it more, right? You
Hmm.
think of day trading, you think of stocks on penny
Yes.
stocks and all that. But if you think about it, legally, to be what's called a pattern day trader, you need to have at least $25,000 in your account. All right. And typically, and that's a legal thing. That's not a
Yes.
broker thing. That's a SEC says you have to have that amount to be able to trade as a day trader. Now, another disadvantage is that if I trade 1,000 shares of Apple or whatever, I have to actually buy those 1,000 shares, 1,000 times the price of Apple. And if
Hmm.
Apple appreciates 1%, well, okay, I have to sell everything now. And then there's issues with that. If you have size, you have to tier it and stuff like that. It's non-trivial how you just do that. Okay. And, but with futures, you have leverage, right? So nobody's actually going and buying 1,000 barrels of oil. We do what's called cash settlement. Okay. So when
Okay.
you buy your oil, so to speak, and then you sell it, right? Every time you enter a futures contract position, we call it a zero sum game, right? So in order for me to buy, there has to be somebody selling, and once I have that position, I have to get out of it, right?
Hmm.
Before the contract expires, unless we have rollover, that's a little bit more advanced. But suffice it to say, you got to get out. Okay.
Hmm.
So when
Yes.
I get out, I take that difference. Now, hopefully, if I bought oil at say $55 a barrel, and it goes up to 55.10, just for example, you take that difference, or 56 or whatever, you take that difference.
Hmm.
If it went the other way, well, of course, you lose money.
Yes.
Okay, but it's the point is it's a cash settled contract typically. Now, if these things exist for a reason, and this is actually in this very module, so you're leading us off with a great question, because we're talking about that whole concept tonight, is that these things exist for a reason, right? We have what's called hedgers and speculators, okay, and we work in tandem. So if I am, let's say I'm American Airlines,
Yes.
right? And the price, my profit margin greatly depends on the price of oil, because I'm flying around millions of people every day, right? Or every week or whatever. You get the point. One of the biggest airlines in the world. Okay. And so if the price of oil starts going up, it's really going to cut into my profits. All of a sudden your ticket is going from 300 to, say, go to the US to see me in Miami. It's going to go to 600, right? You're not going to like that. Okay. So their profit's going to go down. So what they do is they hedge themselves by buying a bunch of contracts worth of oil. Right.
Okay, yes.
Right. So worst case scenario, you know, they lost money in their revenue, but they hedged themselves. And that's what the nature of hedging is that you take the opposite position just in case the shit hits the fan, life doesn't go your way, right? And you have to rely on that hedge to balance things out for you. And that position, they can actually say, hey, you know, instead of just having to buy that oil, they can actually convert, right, those contracts into actual physical barrels of oil. Okay. But we don't, in the type of trading we're going to do you really want $1,000 worth, 1,000 barrels of oil showing up at your door? Probably not. Okay. So it's what we call cash settled, because you're really just betting on the price. But remember that hedgers and speculators, we work together, because it's a zero-sum game. I can't enter a contract if there's nobody selling. If I want to buy and nobody's selling, I'm stuck, right?
Yeah.
So a lot of times these hedgers provide us liquidity to get into positions, okay? Because if they want to enter a hedge, they have to put orders in at certain slots in the market so that they can get filled, right? So that they can have something to work with, right? And that's where hedgers and speculators provide liquidity to each other, right? There's a contract for one that the other will take.